Hello everybody, in this video I want to go over out of the money covered calls. I have already made an introductory video going over covered calls in general. However, in this video I want to focus specifically on out of the money covered calls. Let's get started. How to sell an out of the money covered call. First, you have to buy 100 shares of a stock, which will be used as collateral, and then you sell a call option at a strike price above the current stock price. Let's look at an example. For example, Amazon is at $109.90. If I wanted to sell an out of the money covered call on Amazon, I would first have to buy 100 shares of Amazon. And then I would go to Trade Amazon Options, choose an expiration date, for example, October 20th, and then sell a call at a strike price above the current stock price. So the stock price is $109.90. Sell at a strike price of $130, for example. That would be an out of the money covered call. Because the strike price, 130, is above the share price, which is 109. What are the advantages of out of the money covered calls? At expiration, if the stock price stays below the strike price, you simply collect the premium and keep 100 shares in your account that you were using as collateral. So, for the example that I gave, this $130 call, this is worth $3.40. Times 100, that's $340. At expiration, I would get $340. I would basically get this small amount of money and then just keep the 100 shares of Amazon that I bought. It's like getting extra money pretty much in this example. Now, at expiration, if the stock price goes above the strike price, that means I made money from the stock price increasing and I collect the premium anyways. And the 100 shares do not stay in my account, they disappear basically. So let's say that the stock price goes above $130 in this example. Let's say Amazon goes to $140 at expiration. Because Amazon increased from $109 to $140, I make some gains from the stock price increasing. And I still keep the $340 of premium that I got for selling the covered call. So either way, I make some type of money, either by collecting the premium or by the stock price increasing and collecting the premium anyways. The major difference to pay attention to is that at expiration, if the stock price stays below the strike price, you keep the 100 shares in your account. If the stock price is above the strike price at expiration, the 100 shares that you used as collateral will basically disappear from your account. They'll be called away. What are the disadvantages of out of the money covered calls? Like any covered calls, you're limiting your potential gains. Sure, you're collecting that premium, right? You're collecting that small amount of money, but in return for that, you're limiting the max gains you can make. And if the stock price soars way above your break-even price, you missed out on gains. Let's say, for example, you do this covered call that I was talking about, right? This out of the money covered call with the $130 strike price for Amazon. As you can see right here, the break-even is $133.40. Let's say that Amazon at expiration jumps up to $200 a share. It's not going to matter. Anything past $133.40, you don't really see the gains go to you for that. You're capping the max amount that you can gain. I'll show you later what I mean when we look at the chart. But you're basically limiting the maximum gain you can get. Now let's look at some examples using optionsprofitcalculator.com. I'm going to go to this website, go to covered call, enter the stock, what price I bought it for, and which call I'm selling. So here's optionsprofitcalculator.com. I'm going to click on covered call, choose the stock. Let's keep on going with Amazon. Click on get price. $109.87 is the current price. Again, in order to do covered calls, you have to buy 100 shares of the stock. So buy 100 shares of Amazon, and you're going to sell or write a call option, pick an expiration date, and the strike price has to be above the current price. So the current price is around $109.87. Let's do 120. All right, and then click on calculate. So here's the chart for our out of the money covered call. At expiration, let's say it's at 120. We would gain 16.1%. Now let's say it's at $126. We would still be at 16.1%. Let's say it's at $130. You guessed it, our gain would still be 16.1%. Let's say the price of Amazon goes up to $1 million per share. Yes, our gain would still be 16.1%. This is what I mean by you're capping your maximum gain. You cannot gain anything more than 16.1%. No matter how high Amazon goes at expiration, that's the maximum amount you can gain, no matter what. In this example. Now, let's say you weren't doing a covered call at all, and you just had the shares of Amazon without any covered calls. Well then, if Amazon goes up to $1,000 per share at expiration, you would actually get the full gains from that. You won't be capped at 16.1%. You would get the maximum amount. So you have to think about this. There are pros and cons. There's upsides and downsides to doing covered calls. The major downside is that you're putting a cap on your gains. In the event that the stock that you bought 100 shares of skyrockets upwards and just increases exponentially in price, you probably would have been better off not doing a covered call. Now, covered call is good for when you expect it to basically stay the same price or go up just a little bit, but if the price of the stock skyrockets upwards, you probably would have been better off not doing a covered call. So keep that in mind. Now, the advantage is, let's say, for example, right, Amazon at $109.87, let's say it stays around the same price. Let's say it's at $110 or even at $109.50. At expiration, we gained 5.96%. So as you can see, without the stock price even increasing, we made gains. Whereas otherwise, if we had just bought the stock, if it stayed the same price, then it stayed the same price and you don't gain anything. So covered calls in general, you gain a little bit assuming that it stays the same price or goes up just a little bit. But if it goes way past your break-even price and it goes too high, that means you ended up missing out on potential gains. So covered calls in general, you don't want to do covered calls when you expect the price of the stock to skyrocket upwards way past your break-even price. You want to do covered calls in general if you expect the stock to stay the same, neutral, or go up a little bit, but not too much. Now, even if it goes down in price, let's say, for example, Amazon at $109.87, you do a covered call. Let's say it goes down to $108. At expiration, you gain 4.51%. So even when the stock price goes down at expiration because you did the covered call, you might end up gaining anyways, even if the stock price goes down. So there are pros and cons, as you can see, to doing covered calls, right? So that was out of the money covered calls. It's basically a way for people to sort of collect a premium, collect some extra money, because even if the stock price stays the same, because of that premium that you got from selling the covered call, you gain something. You gain something even if the stock price doesn't even change. Even if the stock price goes down a little bit, because you collected that premium, you gained a little bit. And in exchange for that, you're capping your maximum gains that you could get, right? So it's up to you if you think this is a good trade-off. Are you willing to put a cap on the maximum you can gain in order to collect a small premium at expiration? It's up to you. Now, me personally, I do a lot of covered calls, and I do it because I'm okay with putting a cap on my gains just for collecting the premium. So if the stock price stays the same, I make some gains. Even if it goes down a little bit, I make some gains. And I'm willing to do that. I'm willing to trade in, putting a cap on my maximum gains in order to get that benefit. But that's me. It's not for everybody, but as long as you understand what you're getting into, it can be pretty useful. Anyways, this has been my video on out of the money covered calls. A lot of people do out of the money covered calls. They buy 100 shares of a stock and then they sell a call above the current price, right? They pick a strike price that's above the current price. That's an out of the money covered call. And that's basically how it works. All right, thanks so much for watching. I'll see you guys next time. Bye.